students. So I hope everybody is doing good. And I always say, more importantly, you've been made your cumulative revision on financial instruments. Well, so far we have covered the 2 sessions on financial instruments, and our focus of attention has been the issuer perspective. I guess now I think I would add on, as compared to what I said in the previous class. Now you can see that the number of instruments which you can see from the issuer perspective can be classified into a total of 4 broad categories. So I'll just like to take a little warm-up exercise, before we begin, because my focus today is going to be on the compound financial instruments issued by the company. So just to remind you, when I am looking at the issuer perspective, so we can say that the instruments could be categorized into a total of 4 categories from the issuer perspective. So I would say the 4 broad categories dependent upon the 3-step model we identified. One is it becomes an equity instrument. Another is it becomes a financial liability. Third, it becomes a compound financial instrument, which is non-derivative in nature. And the fourth is what we call hybrid instruments. And when you say they are hybrid instruments, it means they are including a derivative. So there is an embedded derivative which is included in these instruments. I think let's also quickly have a look in terms of how they are going to be presented in the balance sheet of the company, because as we started off a journey in terms of Index 32, I said Index 32 talks about financial instruments presentation. So we need to be very clear that when you're going to present these instruments in the balance sheet of the issuer, you are going to present them where? So if I look at the balance sheet perception as well, you can say when you're going to present these instruments in the balance sheet of the company, as far as equity instruments is concerned, they will be presented under the heading equity of the balance sheet, and they would be appearing as an equity share capital. So I would say typically your equity instruments would be your ordinary equity shares, which are non-puttable in nature. So what do you say? Well, I intentionally use some words right at the beginning itself because I wanted to put this term at the back of your mind. So I said that when you're looking at equity instruments which are going to be presented as equity shares, I said they are ordinary share. But I made another input as well, that these equity instruments which are presented are going to be, you can say, non-puttable ordinary shares, non-puttable equity shares, or you can say non-puttable ordinary shares of the company. Now, what do I mean by a non-puttable ordinary shares of the company? When a company issues ordinary shares, what is important is the holder of the instrument. Mind the words. The holder of the instrument has got no right to put the instrument back to the issuer. You've already seen the term puttable, the call and the put options. So when we use the word puttable, it means the holder gets the right to put the instrument back to the issuer. So when you're going to call an ordinary share as a equity instrument, what is important is that it is non-puttable in nature. So let me put it like this, that when you say it is non-puttable, it means in this case, holder has no right. The holder has got no right to put the instrument back, to put the financial instrument back to the issuer. He cannot put this instrument back to the issuer, then we can say it is supposed to be non-puttable in nature. So this is something new which I've added early in the morning. I just wanted to make a point that when you call ordinary share, sir, you mean to say that there could be 2 kinds of ordinary shares as well, one which is puttable in nature and the other which is non-puttable in nature. You got my point correct. So if you say that there are ordinary shares which are puttable in nature, where the holder gets the right to put the instrument back to the issuer, is going to be called as a financial liability. I put it again. I said if a company issues, let's say, ordinary shares which are puttable in nature, where the holder gets the right to put the instrument back to the issuer, is a financial liability. So the only ordinary shares, that is equity shares, which are going to be called as equity instrument, need to be non-puttable in nature, where the holder gets no right to put the instrument back to the issuer. That is one kind of instrument presented as equity. Now let's have a look at the second kind of instrument, which is supposed to be a financial liability. This is going. Oh, all okay. I think early in the morning, I said two technical things for my camera, even to digest that as well. Okay, so when you're looking at a financial liability, then these are to be presented in the balance sheet of the company as a liability, non-current liabilities, and they would be appearing in the balance sheet of the company as a borrowings. So they would be non-current in nature and they would be appearing as borrowings in the balance sheet of the company. Then comes the third kind of instrument, which we are going to focus today, and we're going to do a lot of inputs on that particular instrument, CFI. So when you look at a compound financial instruments, we can say in terms of compound financial instruments, you need to split the proceeds. Though I gave you a very basic flavor of how the proceeds are split in terms of FL as well as in terms of equity. So we're going to get a lot of flavor of a split accounting today. But when you consider a compound financial instruments, we split the proceeds of the instrument, and the proceeds of the instrument is split in terms of financial liability as well as the equity component is concerned. I made a mention earlier as well that when it comes to the financial liability component, it is presented as a non-current liability, which is again borrowings. So the presentation of this component is the same as a financial liability. But let me now tell you that when it comes to the equity component of a CFI, that is to be presented in the equity section as other equity. I made a mention of that earlier as well, and today I'm going to show you a lot of inputs in terms of SOKI as well. So this equity element is going to be presented in the balance sheet as other equity, and it would be a part of the statement of changes in equity, which I am going to show you today. So I'm just working a little on the presentation part because the focus in terms of Index 32 is on the presentation aspect, and therefore we should be very clear where you are going to present the instrument as in the balance sheet of the company. And finally, we come to the inputs that is supposed to be hybrid instruments. Let's say if they are compound financial instruments, it's not necessary that hybrid instruments will always be a compound financial instruments, but I'm assuming, of course, that let's say it is a compound financial instruments. Reason, if you look at instruments which are, let's say, with an option to convert, I give you the inputs when the option to convert is there. The company, the issuer, would never pay a rate of interest which is payable on a non-convertible instrument. The tendency of the issuer will always be pay the interest which is below as compared to a non-convertible instrument. So ideally speaking, it should definitely turn out to be a compound financial instruments with an option to convert. So that would be a CFI with a derivative embedded. And we've already seen that in this particular case, depending upon the fixed test passes or not, you will either segregate two elements or you'll segregate three elements of this particular component. Right now, as a part of the presentation, I'm just assuming the fixed test, let's say, fails. So in this particular case, if you say the fixed test fails, then you are going to segregate three elements of this particular instrument. One is the financial liability non-derivative component, again presented in the balance sheet as a non-current liability borrowings.
So,
And then you are going to segregate the financial liability, which is a derivative element, and that is also going to be presented in the liability side of the balance sheet as non-current, but this is a derivative liability. The two components are going to be presented separately in the balance sheet because the accounting for a non-derivative element will be different, and the accounting for a derivative liability will be different. We're going to see the accounting of liabilities when we come to Ind AS 109. But at this stage, let me at least tell you that all derivatives which we had an extensive discussion in the previous class are accounted at a fair value. Every derivative is supposed to be measured at a fair value on the balance sheet date, and any changes in the fair value is taken in the profit and loss section of the company. But as far as non-derivative liabilities are concerned, they will have different accounting. They may not be taken at a fair value, and therefore it is also important that the derivative element of this hybrid instrument is segregated as well. And of
so,
course, we also segregate the equity component as well. So this financial liability element is going to be presented as a non-current liability. This equity element is going to be presented as a part of the other equity. And of course, the derivative component of liability is going to be presented again as a non-current liability separately. So I think that was a little warm-up exercise in the morning, just added a few little things at this stage, but also consolidated the inputs to you. Let me just quickly add on the key issues, what we have learned so far. And then I am going to take you to the deeper discussion of a compound financial instruments today. Okay, so can you please give us a recap on the fix for a fixed test? I'll do that shortly after the recap of this particular chart is concerned. So let's, I think, consolidate the position. Now, what you can see clearly on the board is that when you're looking at the issuer perspective, now mind my words very carefully for the next couple of minutes, because this will, embed the concept of financial instruments in your mind. I'm using technical jargons, just like financial instruments, embedded derivative. So in this particular case also, I want the concept to get embedded at the back of your minds. So my focus point is when you're looking at a presentation of the instrument from the issuer perspective, we can say there are going to be four kinds of instrument. The instrument, depending upon the three-step model which I have given you, gets classified either as a pure equity instrument, or it gets classified as a pure financial liability, and they're all non-derivative in nature, or it is classified as a compound financial instruments, again non-derivative in nature, or it could be a hybrid instrument with a derivative embedded. So when you're looking at equity or financial liability or CFI, they're all non-derivative instruments. This is hybrid. It contains a derivative and a non-derivative element. So we've already seen the three-step model with the help of which you are going to get the focus that is it equity, FL, CFI, or hybrid in nature. Now, when you are looking at equity instruments, let me make it very clear that when you are looking at equity instruments, it is the ordinary shares of the company, it is the equity shares of the company which is going to become an equity instrument. But caution, I just added another element that when you're looking at the ordinary or equity shares of the company, they're basically of two categories. I know if you look at the Companies Act, the Companies Act does not make any such references that equity shares are of two types. But if you look at the Indian accounting standard, it makes it very clear that ordinary shares are of two categories. One is called puttable ordinary shares and one is called non-puttable ordinary share. So just on a little lighter side, when you go for the audit of the company and you look at the ordinary shares in the balance sheet of the company, you need to dig further from the client. find out whether those ordinary shares are non-puttable or not. Because if they are puttable ordinary shares, just because you call them by the name ordinary share does not make them equity instruments. You need to see that those ordinary shares need to be non-puttable in nature. So what do you mean by puttable and non-puttable in nature? When the issuer gets the right to put the instrument back to the issuer. The holder gets the right to put the instrument back to the issuer. It is called puttable ordinary share, which is a financial liability. So in order to call it as an equity instrument, it needs to be non-puttable in shares. Non-puttable means the holder gets no right to put the instrument back. It is going to be presented in the balance sheet under the head equity as an equity share capital. The second is when you're looking at a financial liability, it is going to be presented in the balance sheet as a liability, non-current and under the head borrowings. Specific heading financial liabilities is given under the non-current liabilities as well. The third category of instrument is a compound financial instrument where we said you got to split the proceeds. The total proceeds collected at the time of initial raising of funds need to be split in terms of equity and liability. And we've got a little flavor how that FL is computed. And I gave you the present value of all the future outflow. Because liability is not what you receive today, but liability is what you are going to pay in the future. So let's take the present value of all those future payments and the balancing figure becomes equity. The equity component, as I said, is going to be presented under the head other equity, which is a part of statement of changes in equity, which you're going to make as a separate item apart from the balance sheet of the company. And then we said hybrid instruments, which generally would be a compound financial instruments. And I said the fate of the embedded derivative in the instrument all depends upon do we segregate that or not, depends upon the fixed for a fixed test. I think just to give you a little more insight what my friend said, so a little inputs on fixed for fixed test. Well, if you remember my step number 3, I gave you that for a derivative instrument, you need to check fixed for a fixed test. Now, when you say that there is fixed for a fixed test, there are two elements that is the word fixed. The consideration is fixed and the number of equity shares allotted against that consideration is fixed. When it is a non-derivative instrument, you only focus on the number of shares being fixed or variable. But when it comes to a derivative instrument, your focus is not only on the number, but also on the consideration. In terms of a derivative instrument, the consideration will be received in the future. The allotment of shares against that consideration will take place in the future. So there is going to be a future consideration which needs to be fixed. There is a number of shares to be allotted against that consideration which needs to be fixed. If the consideration and number both is fixed, then you can say the fixed for fixed test passes, it becomes equity. But if any of the two or both the elements are variable, either the consideration is variable or the number is variable or both are variable in nature, the fixed for fixed test will fail. And then the derivative element is going to be called as a financial liability. So my assumption in this particular case, what I've written so far, is that if the fixed for fixed test fail, it can pass, it can fail, but just to present, then you need to segregate 3 elements of the instrument. You need to segregate the non-derivative FL, when you need to segregate the derivative component of the FL, which a valuer can do it for you, because you need to use the concept of, for example, a Black-Scholes model, which will help you to calculate what is the valuation of the derivative. And the equity component will be segregated and they will be presented in the balance sheet as 3 separate line items in the balance sheet. I hope, friends, I have made myself clear. That was a summary of what we have discussed so far in the previous 2 sessions. As I said, as we go to progress further, you need to do your cumulative revisions. I'm also going to help you out in terms of getting the fundas very clear. I hope the revision early in the morning works. Right, I hope you got your answer. I guess who asked me about a fixed for fixed test. Now, let's go further. Now my focus today is only on a compound financial instruments. I've done my discussions on equity instruments. I've done my discussions on FL. My focus is now going to be either on the hybrid kind of instruments or on a pure non-derivative CFI. The focus is completely on a compound financial instruments. It's accounting. We are yet to do the accounting of financial liability. The accounting of financial liability will be done when we come to Ind AS 109. There is hardly any accounting in terms of equity instruments, because if you raise equity shares, you've done entries since childhood. Bank account debit, equity share capital credit, share premium gets a credit, and that's it. And there is no subsequent accounting which happens for equity share capital. It remains in the balance sheet as it is till you can say the company liquidates. So there is nothing to be taught in terms of equity accounting. Financial liability accounting we'll see focus when we come to 109. Now we are focusing in terms of compound financial instruments. Now at this stage, I think one very important element which I would like to tell you, because these thoughts will definitely trigger your mind and you will continuously ask yourself and me as well, sir logic. I am going to give you a technique of segregating the proceeds in terms of CFI. And I'm also going to give you how does the accounting of the financial liability and the equity component of a CFI takes place. But continuously you will have a question, so why are you doing the accounting like this? It'll be difficult for me to give you a complete logic at this stage. So there will be a certain missing element in terms of a comprehensive logic that why is this accounting happening like this? So may I take the liberty of telling you that you will get a deeper logic in the next class. Because in next class, I will give you the different kinds of measurement bases which are allowed in financial instruments, and why these different kind of measurement bases are allowed. Now, if I get into the discussion today, I'll deviate from my topic. So I am not going to give you a very deep logic today in terms of why the accounting is done in this style. So please bear with me, because I'll give you a technique in terms of how the accounting is done. Now, why is that accounting being done in a similar manner? You will get a little logic, but you'll get a more deeper logic in the next class when I come to the concept of different measurement base. So don't get worried. So let's concentrate on how it is to be done at the moment. The why is also going to come at a very appropriate time. You're going to wait for this till Thursday. You are going to get inputs on that. So on that note, let me start with the discussions on a compound financial instruments. My mind is now telling me a couple of things, and I want to take each one of these instruments one by one. I'll give you a complete accounting from the inception till the maturity of the instruments, and also give you the extracts in terms of how things would appear in the balance sheet or in terms of SOKI. So what you're going to witness right now is a couple of illustrations which will give you a complete chain of thought and a complete clarity. And once we're done with all these illustrations, in the end, I'll give you a summary chart as well. Now, when I look at a compound financial instruments, I am first of all thinking in terms of various kinds of instruments. My mind is now working on a total of 4 categories of instruments which can turn out to be CFI. I gave a little flavor in the last class as well, but I'm just going to add more inputs now. Well, the first category is that there is a perpetual debt instruments. I'm going to first pick up a perpetual debt instrument. And I think I would like to remind you back again that when you look at a perpetual debt instrument, it is purely non-derivative in nature. So there is no question of any ED. It's not a hybrid instrument. So when you're looking at a perpetual debt instrument, it is supposed to be a non-derivative instrument. And the fate whether it becomes a compound financial instrument or whether it becomes a case of financial liability, depends entirely on what factor. Let me ask you that. When you look at a perpetual debt instrument, a bell stands in your mind. घंटी आपके दिमाग में बचेगी. Yes, beta.
Contracted and marketed.
Wonderful indeed. So you are going to compare the contracted rate and the market rate. They need to be different. In other words, we can say the contracted rate should be lesser as compared to the market rate of interest. And then undoubtedly you can say it is going to be a compound financial instruments for sure, where we learn the split accounting. So this is case one, which I will do with you. The second kind of instruments which turns out to be a compound financial instruments, I am looking at conversion option. I'm not looking at those cases where one component is fixed and all those things. Today, my concentration is in terms of those where there is going to be a conversion, of the instruments in terms of ordinary shares in the future. And when I'm looking at this conversion, I'm looking at three kinds of instruments. One is optionally convertible, one is partly convertible, and one is mandatorily convertible. You got me correct. My focus is on the conversion, so I am looking in terms of that they are optionally convertible, or we can say they are partly convertible, or we can say they are mandatorily convertible. Now, in this particular case, every term has got a huge significance as we see the accounting. So when I say that it is going to be optionally convertible, we are basically saying it is like OCPS, optionally convertible preference shares, or it could be OCD, that is optionally convertible debenture. Even in a practical world, we always use these terms and we say a company is issued an OCPS or the company is issued an OCD. And here again, I am of course assuming that this option to convert is available with the holder. The holder is getting an option to convert in this particular case. Now let's make it very clear. When you say that there is an option to convert, it is definitely a hybrid instrument, because the option to convert is the derivative which is embedded in the instrument. So in this particular case, we can undoubtedly say, unlike this is a non-derivative, this is going to be, you can say, a non-derivative plus a derivative which is embedded in the instrument. Let's call it as ED. So in this particular case, I would say it's a hybrid instrument, which of course will be a CFI with a derivative embedded. The derivative will be segregated or not, it all depends upon the fix for fix test in this case. So I'll call this as an hybrid instrument. This is going to be a hybrid instrument, and whether the derivative is segregated or not depends upon the status of the fix for fix test. So I think let me just pinpoint out here as well that this embedded derivative, the segregation is done or not. The segregation is done or not depends upon the fixed for fixed test. It depends upon the fixed for a fixed test whether this derivative is to be segregated or not. I hope my chain of thought is very, very clear. So I've given you the inputs in terms of optionally convertible instruments, which will turn out to be hybrid instruments, and you will split the equity as well as FL non-derivative. But whether the derivative will be segregated purely depends upon the fix for a fixed test. Then comes the next one, which is supposed to be a partly convertible debt. So when you say partly convertible instruments, it is generally PCD. That's called partially convertible debenture. Or there could also be partly convertible preference shares as well. So let's put it like this. It could also be partly convertible preference shares as well. But most commonly you see instruments like PCD. That is called partially convertible debentures. Now, when you say it is partially convertible debentures, a portion of the principal will be converted in ordinary share. Let's say 50% convertible in ordinary share and 50% is paid in cash. So this is what we call partly convertible. That means, let's say it could be 50-50, not necessarily 50-50, but just for understanding. So let's say 50% of this money is paid in cash and 50% of the principal money is going to be paid in terms of shares. I think we'll talk of this instrument as we come to a practical illustration. And then comes what we call mandatorily convertible, what we call compulsory convertible preference share, CCPS. Or we can say it can be compulsory convertible debenture, CCD. It's not cafe coffee day. It's called compulsory convertible debenture. So in this particular case, when you look at the mandatorily convertible, the common name is CCPS, or what we call compulsory convertible debenture, CCD. So next time when people tell you in a practical world, the company has issued an OCPS or they've issued a CCPS, you very clearly know what are we talking of. So in this case, when you say it's a compulsory convertible preference share or a compulsory convertible debentures, that means the entire principal money. Unlike in this case, 50%, you can say 100% is going to be given in terms of share. 100% of the principal will be given in terms of share. We'll deal with that question also later. And you know, apart from all this, we're also going to add another flavor as well. Morning, when you're eating a dosa, for example, you may not like to eat a plain dosa. You would like to get some masala dosa. I also love dosa. Onion, rava, masala, dosa. So to add that masala to all these things, we're also going to introduce the concept of TC. And the TC, I'm just giving you a chain of thought of how I'm going to take my discussions today further. The concept of TC is called a transaction cost. When a company issues a particular instrument, they may incur some money, what is called an issue expense. And in terms of Indies, we technically call this as a transaction cost. So in some way or the other, in some questions, we're also going to add the flavor of a transaction cost as well. How does the transaction cost make an impact in terms of my calculation? So I am going to do a total of 4 questions with you, A to Z. I'm going to make a walkthrough in terms of number 1, perpetual debt instruments. Then I'm going to consider the concept of OCPS or OCD. I'm going to consider the concept of PCD. I'm going to cover the concept of what we call compulsory convertible, that is CCPS or CCD. And we'll see how these instruments are going to be accounted and presented in the balance sheet of the issuer as well. That was just a chain of thought. Let's begin the journey. I hope you've understood my focus point. How am I going to proceed? We're doing a deep level of, you can say, PhD in terms of, these kind of instruments as well. Let's begin the journey. I hope you got my points very clear. Okay, that's superb indeed. So let me do one thing. Let me, start with a simple little question with you. I want to take you to the accounting part and let's have a look at illustration number 28. We're looking at illustration number 28 in unit number 3. This is unit number 3 and we're looking at the illustration number 28. Now we're looking at the accounting. So we will first identify it is a CFI or not, and then we look at the accounting. It says P company issuer takes a loan from Q for 12 lakhs and the loan is perpetual. The moment you read the word perpetual, ghanti baji. And it says it entitles the holder to a fixed rate of 8% and the rate of interest commensurate with the credit risk profile is 12%. So 8% is the contracted rate, and as per the credit risk profile, the market rate is 12%. I think you've already got the point. The CR is less than the MR. It is supposed to be a compound financial instruments. My contracted rate is less as compared to market rate. This becomes a compound financial instrument. Calculate the value of liability and the equity components of this particular instrument. The calculations are already done, but I want to take you to a larger side now. Okay, so what we are going to do now, we need to do the concept of a split accounting. So let me present the answer to you. So let me present the answer. This is illustration number 28 of the study material. So we are looking at this as a perpetual debt. And in terms of a perpetual debt, you can first clearly tell the examiner how did you identify that it is supposed to be a compound financial instruments. Tell the examiner that the contracted rate is 8%. The market rate is supposed to be 12%. And we can clearly say the contracted rate is less than the market rate. So this implies it is a compound financial instrument. Then we are going to go to the accounting and do what we call split accounting. So we will do the split accounting of the total proceeds of this instrument. Now, when you do the split accounting of this particular instrument, the proceeds are to be segregated in terms of financial liability and in terms of equity. So let's go back. The loan is raised for 12 lakh rupees. So when the loan is raised for 12 lakh rupees, the proceeds of this instrument is supposed to be 12 lakhs. Now we need to understand one very simple thing. As I said earlier, the liability is what you're going to pay. And I am going to pay an interest forever. So there is an annuity which is in the form of interest which is going to be paid till perpetuity. And the present value of annuity till perpetuity is taken as A by R. So in this particular case, when you calculate the financial liability, we need the present value of the annuity till perpetuity. We need the present value of annuity till perpetuity, where the annuity in my example is the interest element. So let's see what is the interest. On 12 lakh rupees, the contracted rate is 8%. So 8% of this is going to be 96,000. So this is the annuity divided by the rate of interest, which is market rate of interest. As I said earlier as well, when you are going to consider a perpetual debt instrument, the rate at which a discounting will take place is the market rate given in the question. So 96,000 is divided by 12%, A by R. So this works out at 8 lakhs. Now we can clearly see that out of this 12 lakh rupees, 8 lakhs is the financial liability. So the balancing figure, that is 4 lakh rupees, is going to be equity. And I would like to also pinpoint once again what we did earlier, that if the contracted and the market rate is equal, then you can see there is no equity. Let's assume that if the market rate and the contracted rate is both 8%, 96,000 divided by 8% will give you 12 lakhs itself. The proceeds in that case will equal the financial liability and there will be no equity element. So the concept of CFI can trigger only and only if the CR is supposed to be less than MR. So in a situation where the CR/MR is equal, you will calculate the FL. The FL itself will equal the proceeds of the company. I hope I'm very clear with the picture. So in this particular case now, let's see what is the journal entry I am going to pass at the initial recognition. Let's have a look at the journal entry as well at the time of initial recognition. The company as an issuer puts the entry bank account debit, which is equal to the proceeds of 12 lakh, and the financial liability gets a credit to the extent of 8 lakhs, and the remaining 4 lakh rupees will be put in terms of equity. So this is the journal entry which we are going to pass at the very inception of the instrument. In this particular case, we will put the entry bank debit. I remember, when we were in school, the entry was bank debit 12 lakh and debenture credit 12 lakh. But now, as per the Ind AS, the entry is bank with the proceeds. The financial liability is not the proceeds, but the present value of annuity till perpetuity. And the balancing figure in this case is equity. So this is the proceeds, and this is what we can say technically the fair value of the financial liability, and this becomes a balancing figure as well. Now, I think let's have a little more look further as well, and let's see how this accounting of this FL ledger will take place. So I'm just going to add more flavor to this. And I also want to show you how the ledger account of this financial liability will look like. And I also want to show you how this equity component is going to be presented in the statement of changes in equity. So first, let's concentrate on the ledger account for the financial liability element. Now watch this carefully, because what you're about to witness out here is going to be very interesting. You will again say logic. As I said, a major part of the logics will come in the next class when I give you more deeper in terms of the measurement base and the logics. Right now, watch the technique. So at the time of initial recognition, the entry is bank gets a debit and the financial liability gets a credit of 8 lakh. We are only looking at the ledger element of the financial liability. So we put an entry that is bank gets a debit and the 8 lakhs is FL. Now see, there is one particular rule in terms of Ind AS, and this rule works everywhere in every standard. Trust me, you look at this particular concept, what I'm about to tell you is equally applicable in entire Indian accounting standards. In Ind AS, if anywhere in Ind AS, you are going to capture the present value, what are you doing technically? You are doing a discounting. Mind the words very carefully, because this is going to help you in many standards indeed. In terms of Ind AS, when you consider the present value of a future payment, you are doing discounting. In Ind AS, if you do a discounting, trust me, you are going to do compounding in the years to come. The golden rule which I'm giving you in terms of Ind AS is, if you do a discounting, you need to do in the later years compounding, and that compounding is technically called unwinding of discount. So the concept applies everywhere. Like for example, if you remember, even in terms of Ind AS 16, property, plant, equipment, you would remember the concept of provision for decommissioning liability. That's what you call a provision for drawl. And you would have witnessed that when you consider the provision for drawl, you took the present value of all the future payments. And then you started doing unwinding and you started recording a finance charge as well. So similarly out here, even in terms of compound financial instruments, you're going to see the same thing. This 8 lakh rupees is nothing but it is a present value of the future payment. Since it is a present value of the future payments, I now need to do the compounding, that is called unwinding. So when you do the unwinding, the entry is finance charge gets a debit and the financial liability gets a credit, and we are going to calculate the interest on this at market rate, that is 12%. The logic is going to be simple. Discounting was done at 12%, so even the compounding, that is unwinding, is done at 12%. So we're going to do the unwinding at 12%, that works out at 96. I hope you got the point. So remember, the golden rule of accounting is that when you've considered discounting, you need to do compounding, and so that you reach the same place back. That's called UOD, unwinding of discount. Then at the end of the first year, the company is also going to pay interest in cash. The company is also liable to pay interest at the rate of 8% on that total money proceeds. So in this particular case, when you consider the element of payment on 12 lakh rupees, we are going to pay 8% interest, and that works out at 96,000. Watch the figures carefully. What I am unwinding is at 12%. What I am making a payment is at the rate of 8%. And you know what? In this particular case, please also remember, when the company makes an income statement, this is going to be debited to the profit and loss account. I'm not going to debit this in the P&L. I'm not going to debit what I pay. I'm not going to debit what I pay, but I am going to debit what I am supposed to pay. The figure which enters in the P&L is the figure of 96, though they are both by chance the same. In case of perpetual instruments, you will notice the figure of finance charge and the figure of bank will be same. Only for perpetual. Only for the case number 1, you're going to see that the figure which appears out here and the figure which appears out here is by chance going to be same. This will be typical only for a perpetual debt instruments. As we progress in other cases, the figures will not be same. And then you take the balance CD as a balancing figure, and this works out at 8 lakh rupees balancing figure. And trust me, the ledger account goes on absolutely on the similar lines. The balance CD is going to become your balance BD in the next year, and it will continue year by year like this. So this balance CD becomes a balance BD of 8 lakh rupees, and trust me, you are going to make the ledger account absolutely in a similar manner. I hope I made my points very clear on the accounting of the financial liability element of a CFI. Let's also have a look at that 4 lakh rupees. Where did that go? Now I want to look at the equity component as well. I also want to see what happens to that equity component as well, because you put the entry bank debit, FL credit, and equity gets a credit. So we want to see where is this figure of 4 lakh rupees going to be taken. So this 4 lakh rupees is going to be taken in terms of SOKI. This is going to be taken in terms of SOKI. Now please watch this carefully as I give you some insights about SOKI. So I'm going to give you a few insights about SOKI as well, though we had some insights about SOKI in the very first session when the classes started off. I hope many of you have seen those classes as well. If some of you have not seen, my request, my advice would be, please go back and look at the first initial 2 classes which happened on, at the very start, where we understood the concept of other comprehensive income as well as the concept of SOKI. I'm just trying to take a little recap back out here. Now, when you present a statement of changes in equity, one thing which you need to be very careful on, and I will build this concept later in a more detail in the coming sessions as well. Your statement of changes in equity is supposed to be comprising of a total of 3 tabs. When you consider a statement of change in equity, you can say the entire headings of SOKI is divided in terms of 3 tabs. There is a tab number 1, that is what we practically use it, and there is a tab number 2, and there is a tab number 3. This is how we practically work. Because I'm not looking at from the examination point of view, you may not see this in the books and all, or even mentioned in the study, but this is how we practically do, that when you make a statement of changes in equity, we consider a position of 3 tabs. And when you consider a position of 3 tabs, the tab number 1 is called equity component of CFI. It is called equity component of compound financial instrument. So this 4 lakh rupees, which is the equity component, will be resting in the tab number 1. And just to also remind you, in terms of the tab number 2, the tab number 2 is called the reserve and surplus, where we've got a multiple of items, like we've got a share premium, we've got a capital reserve, we've got a retained earnings. So there are various elements in the tab number 2. And then there is a tab number 3, which is called the other comprehensive income. So right now my focus is not on the tab number 2 or on the tab number 3, but the focus in terms of CFI is on the tab number 1. The equity component of the CFI is going to rest in the tab number 1 out here, that is 4 lakh rupee. So what happens to this 4 lakh rupees? Once this instrument is gone, though it's a perpetual debt instrument, but let's assume once this component is gone, once the instrument is gone, let's say even on liquidation of the company. So once this component is gone, this 4 lakh rupees will be transferred to the tab number 2. This money will be shifted in terms of tab number 2 on the liquidation of the company. This money is going to be put in terms of retained earnings in terms of tab number 2 at the end on the liquidation of the company. So what I have given you in terms of insight is the accounting for the financial liability element, the accounting for the equity component of the CFI as well. The equity component of the CFI is going to rest in the tab number 1, and once the company liquidates, this money will be shifted in terms of the tab number 2 in retained earnings. At that particular stage, this money becomes available to be paid to the shareholders of the company. Right, friends, I hope my case number 1, illustration number 27 from the very start till the end is 100% clear. Give me a yes or no if you're absolutely clear with this agenda. Wonderful indeed. That's great. Okay, so I think with this inputs in hand, let's go back. So I've given you the inputs on illustration number 28. Now I want to take you further, and we want to go to illustration number 29. So let me take you to now illustration number 29 as well. We're going to the second case, that is optionally convertible preference share, OCPS, OCD, which is going to be, of course, a hybrid kind of instrument as well. For we need to see that if the fixed for fixed test is passes, the equity, the derivative is not to be segregated, otherwise it is going to be segregated as well. So let's have a look further out here in illustration number 29. This was 28 only, yes. Did I mark it as 27 or 28? 28, that's fine. Okay, let's look at illustration 29. It says on 1st July X1, D issues preference share for consideration of 10 lakh rupee. It says the holder has got an option to convert. The moment you read there is an option to convert, what comes in the mind is a derivative embedded in the instrument. So it says it has got an option to convert to a fixed number of equity instruments anytime up to a period of 3 years. And the option is not exercised, the preference shares are redeemed at the end of 3 years. So in any case, the issuer has got an unavoidable obligation to pay cash for the entire principal money, because the option to convert is with the holder. He says, give me shares, I give him shares. He says, give me cash, I need to pay him cash at the end of 3 years. The preference shares carries a fixed dividend. So they carry a fixed coupon of 6% every year. So it says they carries a fixed coupon of 6% and is payable every year. The prevailing market rate for preference shares without the conversion feature is 9%. We need to calculate the liability and the equity components again. I guess you will easily agree with me again on this particular point. If you remember the story which I gave you for 3 people, Mr. A, Mr. B, and Mr. C, is this a case of Mr. C? Is this a case where the C is told that we are paying interest at the rate of 9% to Mr. A, but since you get an option to convert, I'm going to give you a 6%, which means it is a compound financial instrument and there is a derivative embedded in the instrument where the option is to give fixed number of shares and the consideration received is already been fixed. Which means in this case, the fixed for a fixed test is going to pass, and if it is going to pass, we will not segregate the derivative in this particular instrument. Because in this particular case, the concept all depends upon when you are going to test the derivative for a fixed test, the consideration already received, which is 10 lakh, and the number is going to be fixed in number as already stated. So in this case, the derivative is not to be segregated. So we're just going to segregate the FL and the equity element as well. Now, let's concentrate on this case. There are some typical kind of inputs which you need to keep in mind. So in this particular case, what is the rate at which FL is taken? My liability is again the present value of future payments. And when I say the present value of future payments, you need to get the list of all unavoidable obligations. Mind the words. You need to consider the present value of all the unavoidable obligations in the future. As an issuer, you've got an unavoidable obligation to pay a coupon rate of 6% and the principal money which is going to be paid at the end of the redemption. And what is the rate at which a discounting will take place? The standard very clearly says you are going to use the rate which is prevailing on a non-convertible instrument. The question very clearly says the prevailing market rate for similar preference shares without conversion is 9. So in any case, for a compound financial instrument, the discount rate will be given and it will always be the coupon rate, the market rate, which is on a non-convertible instrument. Let's do this one also in a detail. Let's go to illustration 29. So let me just add illustration number 29 as well. So let's go to illustration 29. So this is my second case where I am looking at optionally convertible preference shares. We're looking at optionally convertible preference shares. In short, we can call it as OCPS. So optionally convertible preference shares, in short, it is OCPS. So I would say, yes, there is a derivative embedded, but then it passes a fixed for fixed test. So we can say it is a compound financial instrument with an embedded derivative. And this embedded derivative passes the fixed for fixed test. And therefore, the derivative is not to be segregated. Therefore, the derivative is not segregated. So tell the examiner clearly in terms of your understanding that since the embedded derivative is going to pass the fixed for a fixed test, therefore we will not segregate the derivative. So again, we need to do the split accounting. So let's understand again how the split accounting in this particular case is going to take care. Let me also tell you the key agendas which should go at the back of your mind. In all these cases, what I'm doing with you today, you need to be careful in terms of number one, discounting rate to be used. And number two, accounting for the FL element. Number three, accounting in terms of the equity component. So these three agendas need to be very clear. How the split accounting is done, what is the rate of discount you're going to consider, how the financial liability element is going to be accounted over the years, and how the equity component is to be done. If you're clear on these three agendas, the accounting for CFI is very much clear. So again, in terms of the proceeds, I need to go back to the proceeds. So if you look at the proceeds out here, I am given the proceeds are to the extent of 10 lakh. And what is the life of the instrument is 3 years. So we've got a proceeds to the extent of 10 lakh rupees. So we need to split this 10 lakh rupees in terms of FL as well as in terms of equity. And the same funda would apply when you look at the financial liability and when you look at the equity element as well. The financial liability in this particular case is going to be based on what? The present value of all the unavoidable obligations in cash. I am liable to pay a 6% coupon rate for the next 3 years as an issuer. I'm liable to pay the principal money of 10 lakhs at the end of third year, discount them at the market rate, which is without conversion 9%. So what we're going to do in this particular case, so we need to consider on 10 lakh rupees, there is a 6% coupon, and you're also going to pay that 10 lakh rupees. So we need to discount this at, give me a PVIFA, which is at the rate of 9% for 3 years. And also give me a PVIF, which is at the rate of 9%, which is third year end. So we need to consider the present value factors, and the present value factor in this particular case, we need a cumulative factor 9% 3 years, and we need a factor at the end of third year. So let's see what is the factor. So at 9%, if I take the factor at the end of third year, I think it's 0.772 if I'm right. And I think the cumulative is 2.531. Just vouch me the calculations. And I think that's right. 924064 is the total. Okay. So this is 151,860. I think it's 923,860, which I am getting. Please check this. It's 923,860 is the present value of the total interest and the principal obligation. Please verify this to me. I'm just going to make quickly the calculations again. 2.531, 151,860. Yes, I think it is 923,860. Correct. Please, anybody else verify this as well. Everything is dependent upon my calculations out here. And we're going to take the equity as a balancing figure. Out of the 10 lakh rupees, we reduce the proceeds. That is 923,860. 76,140 is the balancing figure, which is the equity component of the instrument. Great. Wonderful indeed. Okay, so now I think we are again going to look at a ledger account, and let's make a financial liability. Do you think this is technical? I don't think so. I think you would learn the technique. Yes, there might be some questions coming in the back of the mind in terms of, so why are we doing this unwinding, etc., etc. As I said, you'll get more deeper logics in the next session for sure. So let's now consider the ledger account as well. So let's make a ledger account for a financial liability, and this time you're going to see some wonderful results coming in. Because unlike a perpetual debt instruments, in this case, when you're going to look at the interest, you're going to see the finance charge different as compared to the payments which are made. So let's put the entry. So let's put the entry out here as well. So what is my journal entry? Bank gets a debit to the extent of the total proceeds 10 lakh. The financial liability gets a credit 923,860. And the equity gets a credit, which is 76,140. This is what the journal entry at the inception would look like. So this is how my journal entry will be done at the very inception. Bank gets a debit. And I remember in school, we never used to think like this. The answer in terms of issue entry will always used to be bank debit, preference share credit, or bank debit, debenture credit. But now we know that in this particular case, it's a compound instrument. So you need to split the amount of FL and split the amount of equity. So now let's see 923,860, how this will be accounted for. So in the financial liability, you put the entry, bank gets a debit, financial liability gets a credit. And trust me, I'm now again going to do the same compounding as well. So what did you do? You took the discounting. I'm now going to do the compounding, that is unwinding, and this unwinding will be done at what rate of interest? Let's ask you that question as well. What is the rate at which the discounting, the compounding is going to take place? Is it going to be 9%? You're going to take the finance charge, right?
Yes,
The
sir.
unwinding is going to take place, that's right, at the same rate, which is at the rate of 9%. Good. So 923,860 into 9% is 83,147 approximately. And would you like to tell me at the end of first year, how much are you going to pay? I'm going to pay the coupon
60,000.
rate. That's right. That is 60,000. Wonderful indeed. So on the total proceeds of 10 lakh rupee, you're going to pay a 6%. That works out at 60,000. How much are you going to charge in the profit and loss account of the company? Is it going to be 83,147 or is it going to be 60,000?
83,147.
Wonderful indeed. That is absolutely correct. Okay, let me also see if any questions coming on the other way as well. Okay, there are no questions on the other one. Okay, so that's right. So this is the amount which is going to be taken in the P&L. I just like to make a mention as well that this is what is going to be debited in the profit and loss of the company year by year. So for conceptual clarity, let me just make the ledger account for a period of 3 years. So we are very pretty much clear of the concept. So let's make this for a period of 3 years. Let's get the balance CD balancing figure
947.
943
947.
94
947
Oh,
007. It says 947 007.
my mistake. Can you come again bit on this figure?
947 007.
Okay, so that's 947007. That is the balance BD. Great. And trust me, we're going to repeat this entire process all over again. We're going to consider the interest again at the rate of 9%. So unwind this at the rate of 9% on 947007. At 9%, it's
52
852
31.
31. Correct. And then we make a payment as well, which is going to be 60,000. And we
Yes.
again get a balance CD as a balancing figure.
927 972.
927
Sorry, 972 237.
927 237.
972
Oh, it's 972
237.
237. I think it should be 238.
Yes. Yes, 23.
So 972 238. And then again, we take the unwinding, that is finance charge. I would say in the last year, don't take the interest as a computation. It's a last year, we can take as a balancing figure to match the results. Even if you take 9% on this, it's perfectly okay. But my advice is that in the last year, don't take the interest, we'll take it as a balancing figure. Now, something interesting to watch now at this stage. Since it is an optionally convertible debenture or optionally convertible preference share, whatever, in this case, the option to convert is with the holder. So he may opt for cash, he may opt for shares at the end of the third year. So let's have a look at both the elements. If he says, I want shares, then what? If he says, I want cash, then what? So I want to look at the ledger account under two different options. So I want to look at the scenario where the holder says, give me cash, or where the holder says, give me shares. Let's look at both the scenarios for a conceptual clarity in this case. Can I say, if he says, give me cash, I am going to give this 60,000 coupon rate, and I'm also going to give him that 10 lakh rupees, the principal money in cash. Let's now take the finance charge as a balancing figure. So 10 lakh 60 on the debit side, 972 238, it comes to 87762. Just make a check. Is this coming approximately 9% on the opening balance? Should be approximately. It may not exactly match, I guess, but approximately. I think there is a slight little difference, and that
Yes.
could be due to some differences. There is a difference of almost like 260 rupees or something. So that could be due to some decimals what we have taken in the present value factors. for more accurate kind of results, if you consider the figures up to almost like 5-6 decimal places, you're going to get correct answer. But anyway, I've taken 3 decimals, so there could be a slight little difference. Now on the other hand, if he says give me shares, I'll pay that 60,000 coupon rate in terms of cash. The rest would be equity shares plus premium, that is 10 lakh rupee. I don't think so. I am given the number of shares which are allotted, but he says there will be fixed number of shares. So we can segregate the principal and the premium, split that 10 lakh rupees between the principal and the premium, and close this ledger. So this is how the things will look like in the financial liability at the end of third year. Though if you notice in the illustration in the study, they've not made a walkthrough till the end. They just kept it, simple for you, where they've given you the walkthrough in terms of the split accounting, but I am intentionally giving you a ledger movement till the end of the period to get a complete knack of financial liability ledger and the equity. Let's now also have a look at how the equity component is to be dealt with. So we're also going to see in terms of this compound financial instrument, how this equity component of the instrument is also going to be accounted for. Undoubtedly, we know that this equity component of the instrument is standing in the tab number 1 of equity, SOKI. But what happens to this? Now let's see, interesting part. So this is my statement of changes in equity. I'm considering the 3 tabs. Of course, my concentration is in terms of the tab number 1. So this is my tab 1, which is equity component of SOKI. Tab 2 is reserve and surplus, and tab 3 is other comprehensive income. So in this particular case, the equity is 76,140. So this amount would have been taken in the tab number 1 at the very inception. Now watch me carefully. Can I say after the end of 3 years? Now you're going to see something very interesting to watch. After the end of the 3 years, in this particular case, I can say either the holder says give me cash, or the holder says give me shares, as we can see in the ledger. Well, if you notice what the standard says that on redemption, this tab number 1 will be shifted to another component of equity. They've only said it is shifted to another component of equity, but let me tell you which other component it is going to be taken in. If the holder says give me cash, then this money will be shifted to tab number 2 under the head capital reserve. And if he says give me shares, I'm going to put this money in share premium. And the logic is simple. In a situation after 3 years, if the holder says give me shares, that means he paid this excess money at the very inception, which is nothing but a premium for the allotment of shares. Get this clear? When he says at the end of 3 years, give me shares, that means this excess money which he gave you at the inception was nothing but a premium for allotment of shares. And if he says give me cash, then this is a capital gain for the company, and this money is going to be put in the capital reserve. So the status of this amount will depend upon the status of what the holder demands. If the holder at the end of 3 years says give me cash, it becomes capital reserve. When he says that give me shares, it becomes a share premium. Remember, in the first case, the money was taken to tab 2 as a retained earnings on liquidation of the company. Because it was a perpetual debt, so this becomes available only on the liquidation of the company. But in this particular case, it has got a tenure of 3 years, so this money will get converted into a capital reserve or share premium, as the case may be, at the end of 3 years. I hope I'm very clear with the picture of the equity component accounting as well. What do you say? Are we pretty clear with the case number 2, A to Z as well? Very good.
Yes, sir.
Simple. Great. So we've got perpetual debt instruments, one case clear. We've got optionally convertible instruments, second case clear. Now we need to go to the third one, that is partly convertible as well as mandatorily convertible. And in terms of mandatory convertible, we'll also add the element of transaction cost as well. So far, I've not added any TC. It is all plain dosa going on. Okay, so let me now do one thing. I am now coming back not to the study, but I'm just picked up some questions from the past examinations, questions and all. And there is one very interesting question now to watch. And I guess let me show you that particular question as well. This is an examination question. This is November 2019 10-marker question. So in fact, the question number 1 and question number 2, which I have stated, is the same question in the study material. So let me pinpoint. We've already done this question number 1. This was the illustration 28 of the study material. And the question number 2 is the illustration number 29 of the study material. So this we've already covered. So the first 2 questions are done. I'm now looking at the third one. And this is an examination question which came in November 2019 for 10 marks in the exam. So let's have a look at this particular question now very carefully. Let's have a look. I'm just going to read the inputs carefully. Have a look. It says we issued 8% convertible debentures on April 15 and the debentures are due for redemption on March 19. Issued on 1st April 15 and they are due for redemption on March 19. That means for a period of 4 years at a premium of 20%. Convertible into equity shares to the extent of 50% and the balance is settled in terms of cash. Can I call this as a PCD, that is a partially convertible debenture, because 50% is in shares and 50% is balance settled in cash. So this becomes a case of PCD, that is a partially convertible debt. Okay, so let's have a look further on this particular case. Then he adds on, it says the interest rate on equivalent debenture without a conversion right is 12%. And we're also given the conversion to equity qualifies as fixed for fixed. Aha. Very clearly he's told you the conversion option qualifies for fixed. Let me ask you the question. Are you going to segregate the derivative element in this particular instrument or not? Let's put that to you.
No, sir. Not segregated.
And that's absolutely correct. When it says it qualifies fixed for fixed test, that means the embedded derivative is not to be segregated, because as we already said, when your derivative meets the fixed for a fixed test, the derivative element is not segregated. So in this case, we can of course notice something. The coupon rate which is being paid is 8% and the interest without conversion is 12%. Definitely, it is a case of a compound financial instrument, hybrid instrument in nature, but the derivative is not to be segregated. And then it says further, you are required to separate the debt equity components at the time of issue and show the accounting entries at the books at initial recognition only. I think I'm going to show you something more than the initial recognition, but I think it's really good. 10 markers only to do a split accounting and only show the entry at initial recognition. Wow. So let's do this question number 3 with you. So let me just add the answer to question number 3, which is based on PCD. And trust me, friends, what you need to do today, of course, is sit down and do each and every of this question by your own hand. You are going to get a good gripping. I know for the last 2 sessions, we've been discussing more of theoretical inputs, hardly much calculations, but today I think the focus is more on the calculations part. So please solve these questions by hand to get a good grip. So we're looking at a case of a partially convertible debenture. We're looking at the case of a partially convertible debenture. So in short, we can call it as PCD. that is partially convertible debenture. So in this particular case, now what we're going to do, we are going to do a split accounting again in this particular case and segregate the amount in this case. So in this particular case, what we need to do in terms of the split accounting, let's see what is the proceeds, and then the proceeds will be segregated in terms of financial liability and in terms of equity. And guess what is going to be the FL and the equity component? And I'm just going to add some more inputs at this stage. So as far as the proceed is concerned, 80,000 debentures of 100 each, that makes it, I guess, a total of what? 80 lakhs
80.
or is it 80 lakhs? The proceeds is to the extent of 80 lakh rupees, and we need to segregate the element of FL. Since the money is going to be paid 50% in shares and 50% in terms of cash, the financial liability will include only the unavoidable amount to be paid in cash. So we are going to consider the financial liability as the interest which you're going to pay for the next 4 years. And we're going to consider only 50% of the principal on redemption, and that also at a premium. Because the question is very clearly said that this money on redemption is payable at a 20% premium. So when you're going to calculate the financial liability for this instrument, since half the money is paid in shares and half the money is paid in terms of, you can say, cash, we will consider only 50% in FL. So let's consider the financial liability element. So we can say on 80 lakh rupees, the coupon rate is 8%. And we need to calculate the PVIFA, which was at 12%, I guess. Yes. So this is going to be at 12% for a period of, I think, 4 years or 5 years.
5
It's
years.
April 15 to March 19, I guess 4 years, right?
Yes,
15 to
4 years.
16, 17, 18, 19, 4 years. So we need accumulation of 4 years in this case, and we will consider 80 lakh rupees to be paid at a 20% premium into 50%. We need a PVIF. This is at the rate of 12% at 4th year end. So let's get the present value factors to calculate the value. So we can take at the rate of 12%. Let's see what is the figure. 1, 2, 3, 4. I think it's already given in the question as well. We should rather pick up the figures from the question itself because it's given. I guess it's 0.625 at the end of the 4th year. And let's see the accumulation of 4 years. 887, 788, 701, 625, 3001, I think. So let's add up all this. We get the financial liability element of this instrument. So this is going to be 80 lakhs at the rate of 8%, 3.001, 1926.40. I guess it is coming to a total of 7920, is it? No. This is 80 lakhs, 1.2, 50%, 6 to 5. 30 lakhs. Just see, is this coming to a total of 49 lakh, 20,640? Just see, is this matching? And
Yes,
we're going to get the equity. Yes, matched. Great. We get the
yes.
equity as a balancing figure in this case. So out of 80 lakhs, we reduce
3072,
49. Yes, 30, 79,
360.
360. Wonderful. Right. So this is the split accounting done. I want to now also again make a run through in terms of the FL ledger. as well as the equity component as well. But first, let's also put a journal entry. You can see the sequence in which I am solving these questions is absolutely in a same manner. So that once you revise, you're able to get a parity of thoughts as well. So bank gets a debit to the extent of 80 lakhs. The financial liability gets a credit to the extent of 49,2640, and the equity gets a credit to the extent of 30,79,360. Right, so now with this entry in hand, we can now have a look at the financial liability ledger. Let's make it for a period of 4 years, because you're going to see something very interesting in the 4th year to watch. So let's make a ledger account for a period of 4 years, financial liability. Then we'll see the equity component as well. Wonderful indeed. Okay, so let's now make a ledger account for a financial liability starting from the very first year itself. So we're going to take the money which is in the bank account. That is, I guess, 49,2640. 49,2640 is the amount. So tell me, what is the rate at which the interest will be unwinded on this particular portion?
12%.
12%.
That's right. At the rate of 12%, we'll do the unwinding in this particular case. So 49,2640, 12% would mean 590,477. 590,477. Then we make a payment that is bank. And this will be at the coupon rate, which is at the rate of 8%.
64,000.
Yes, that's right. 80 lakhs, we take 8%. That is 6 lakh 40.
6,40,000.
Wonderful indeed. So let's get the balance CD as well.
48 lakh 71,117.
Sorry, can you come again?
48 lakh 71,117.
Okay, that's wonderful. So we take the balance BD in the next year, that is 487,117. Let's get the finance charge again.
5 lakh 84,000.
5 lakh 84.
534. 534.
534. Great. The payment is the same, 640. And we're going to get the balance CD, balancing figure again.
48 lakh 15,651.
48 lakh 57,000.
15,000.
15,000.
651.
651. So this comes to 48,15,651. Let's again take the finance charge at 12%.
5 lakh 77,000. 878.
Very good. You've done it very fast indeed. That's great. Then bank is 640. And we get a balance CD, balancing figure.
47, 53, 529.
Okay, that's wonderful indeed. So this is the 3rd year. Finally, now we stand on the 4th year. My idea was to basically show you the inputs in terms of how things will stand at the end of the 4th year. So we take a balance BD, which is 4753,529. Let's not take the finance charge as a calculation. We'll take it as a balancing figure later. Now, in this particular case, what I need to do, this is only the portion which needs to be paid in cash. So I will pay the coupon rate of 8% and the 50% principal money, because the remaining 50% is to be allotted against shares. So when you make the payment in this particular case, we will consider the payment which is the coupon rate 640, and we're going to pay that 50% money at a premium. So 20% was 1.2, 20% premium and 50% cash. Now let's take the finance charge as a balancing figure.
It's 6 lakh 86,471.
Sorry, can you come again?
6,86,471.
So I think this is coming too high. It will not match my 9%. I don't know where the calculations might have gone wrong. Anyway, I'm not worried on the calculations part as such. I'm more worried on the conceptual understanding on this part. So this is coming to 686,471. May not exactly match by 12%. See, does it match almost? Not really. Anyway, the calculations might have been here. But in any case, I'll tell you, the PVIF factors are slightly different what I'm getting on my calculator. So let's not get worried. Whatever is given is okay. Let's now see the larger concept in this case. So now let's see how the accounting for the equity component will be done. How the accounting for the equity component is going to be done. Now watch this carefully. Interesting to watch. Can I say the equity component is going to be used to allot shares? So in this particular case, what was the equity component which is there in my books of accounts? That was 3079360. 3079360. Now at the end of the fourth year, in this particular case, we are going to allot equity shares and also give a credit to the premium. This is how the money will be split. Am I also given the number of shares as well? I don't think so. We are given only 50% is paid, but I'm not given the number of shares and all. Anyway, that's pretty okay. So we can say that this entire amount will be split between the face value and the excess. So let me now pinpoint this in terms of SOKI. So if I were to visualize this in terms of the statement of changes in equity, let me make a statement at this stage. So can I say this is my tab number 1, tab number 2, and tab number 3. We've put this money 3079,360 in tab 1. Can I say a portion of this goes to tab 2? Is that right to say? Not the entire money. Is it correct to say that a portion of this enters in the tab number 2? Am I thinking right? And that is relating to share premium, correct?
Premium.
That's right. And can I say a portion of this will enter the equity share capital on the liability side of the balance sheet, correct? The face value will enter out there. So let me make some interesting statements at this stage. If it is a perpetual debt, does the entire tab 1 go to tab 2 on liquidation? Yes or no? If it is a perpetual debt, the entire element in tab 1 goes to tab 2 on the liquidation of the company, correct?
Yes, sir.
Wonderful indeed. Can I say if it is a case of optionally convertible instruments, the money in tab 1 will go to tab 2, either premium or capital reserve, whatever, but the entire money again goes to tab 2, correct?
Yes, sir.
And in terms of partially convertible instruments, can I say a portion goes in tab 2, which is the premium, the rest is in the balance sheet as equity share capital, correct? Undoubtedly correct, right? Because in this case, the premium is entering in the tab 2 and the rest is entering in terms of the share capital. So you can see very clearly that in terms of perpetual debt, in terms of optionally convertible instruments, the money goes in tab 2. But in terms of partially convertible, the entire money doesn't go to tab 2. Allotment of shares would take place, which would mean in this particular case, a portion goes as a share capital, a portion goes as a premium. Now we need to understand the inputs in terms of mandatorily, there is compulsory convertible debt. Wow, let's go back. So let me introduce you now to another question out here. So let's have a look at question number 4. We'll just have a look at this particular question. We are going to solve it a little after the break, but first I need to discuss this question with you. After we're done with this, we're also going to make a comparative chart in terms of giving you the permutation combinations of discount rates, the treatment in terms of the equity components in various cases. Now, this is a question which is given in the study material as well, and a similar kind of question also came in the exam. And this is also including the concept of transaction cost as well. All the questions we have done so far is not including any element as far as the TC is concerned. So this is also going to introduce you to the concept of transaction cost as well. Let's read. It says ABC company issued a compulsory cumulative convertible preference shares, that is triple CPS, mandatory convertible instrument. It says on April X1 at 150 each, the dividend is payable at the rate of 10% every year. The preference shares are convertible. So when it says they are convertible, it's compulsory convertible into 5,000 equity shares at the end of 5th year from the date of allotment. When the triple CPS are issued, the prevailing market rate for similar debt without conversion is 15%. So the coupon rate is 10%, but without conversion is 15%. And there is a transaction cost which is 2% of the proceeds as well. So there is a TC as well. How does this transaction cost change the inputs? We'll see. Then we're given a summary of all the inputs out here. The allotment is on X1 and the conversion is X6. So there is a total of 5 years after which the conversion will take place. The number, the face value, and the proceeds are given. The rate of dividend is 10 and the market rate is 15, and the transaction cost is already given on 15 lakhs. 2% is the TC, that is 30,000. Face value after conversion and number of shares are given. We need the necessary accounting entries for the entire term of the arrangement, that is from the date of issue till the date of conversion. Wow. So one thing is very clear now. Let me ask you a question. When you are going to consider the split accounting, in this particular case, the principal is going to be paid purely in terms of equity share. So the unavoidable obligation to pay cash is in terms of dividend. So when I'm going to do the split accounting, am I going to consider only the present value of the dividends to be paid for the next 5 years? Am I right?
Yes, sir.
Absolutely correct. So which means when you considered a perpetual debt, you took only the amount of interest every year, no principal. When you took optionally convertible, you took the principal and the coupon rate. When you took partially convertible, you took only the 50% principal and the coupon rate. And when it comes to compulsory convertible, you are considering only the element of interest. Wow. But how does this transaction or cost of 2% undergo a change? That all we'll discuss after the break. I'm sure you need a little mind rest before eating this Ranian Rava Masala Dosa. Okay, so far so good. I think before we take a small little break, I just want to get some insights on your comfort zone. I want you to take a self-assessment scores again on a scale of 10 and give yourself a comfort zone on your understanding on a compound financial instrument so far, the split accounting. That's wonderful. We start with a score of 10 by 10. That is brilliant indeed. And we got another score of 10 by 10. That's brilliant indeed. Super. So I think on that note, let's give you a break and then we'll do this particular question after the break. So 10 to 12 minutes. I see you back. Please enjoy a break. Thank you. So I hope you had a relaxation of mind and ready in order to dig a little more deep in terms of the transaction cost concept as well. So before the break, we were talking in terms of the question number 4, where I said it is a case of a compulsory cumulative convertible preference share. And in this particular case, it is a compulsory convertible, so non-derivative in nature, but there is a transaction cost as well. Now, along with the concept of a split accounting, we also need to understand that if there is a transaction cost, how it is to be dealt with. One thing which I would like to tell you outrightly is that this transaction cost cannot be expensed immediately. If you're thinking that the company incurred a 30,000 of transaction cost, which is 2% on the total proceeds, and it is going to be taken in the P&L, of course not. So what the standard requires us is that it is to be spread over a period of time. Now, how is it to be spread over the period of time is we'll have to basically change the discounting rate at which unwinding is done. Now, how would the discounting rate undergo a change in this particular case? That's what we're going to see in the calculations. So I think let's take this further. So we're looking at the question number 4, which is a case of a compulsory, I'm not writing cumulative, compulsory convertible preference shares. Let's call it as CCPS, though it is triple CPS, but I'm just putting it as CCPS. Now, the first thing is ignore the transaction cost and do the normal split accounting which you do. So what we're going to do, we will ignore the TC for the time being, and ignoring the transaction cost, we'll do the split accounting. We will incorporate this TC at a later stage. So let's see what is the assumed proceeds. The total proceeds are to the extent of 15 lakhs and it has got a life of 5 years and there is a 10% coupon. And there is a 10% coupon rate. So let's organize the total proceeds. So my total proceeds in this case is given to me 15 lakhs. And we will divide this 15 lakhs in terms of FL and in terms of equity. So financial liability and the equity element. And to remind you again, in this particular case, the company is going to pay a 10% coupon rate for the next 5 years and there is going to be no principal repayment. Because in this particular case, the entire principal money is going to be compulsorily convertible in ordinary share. So my financial liability in this case is going to be the amount of dividends only. So when you take the financial liability on 15 lakh rupees, we take a 10% dividend and discount this at the rate of what was the market rate of interest, I guess. That is 15%. So let's see the factor at the rate of 15% for a period of 5 years. We need a PVIFA at 15%. So let's see what is the cumulative factor at 15%. 1, 2, 3, 4, and 5. I think it is coming to 2.781, 2.7804, I would say. Just see if this is correct. 1, 2, 3, 4, 5. No, I think it's 3.352. Can you please check this?
Yes,
Yes,
sir.
sir. 3.352.
Wonderful indeed. So 3.352 into 1,50,000 each year, I think it's coming to 502,800. This is the financial liability. So we'll take the balancing figure, that is the equity component. So out of
997,200.
right, 997,200, that becomes the balancing figure, which is supposed to be the equity component of the proceeds. Wonderful. But this split accounting is being done on the basis of ignoring any transaction cost. But as I said, if in the question you are given a TC, the TC cannot be immediately written off, but it is to be spread over a period of 5 years, and this is going to be incorporated in the discounting rate. Now see how we are going to treat the TC. So in this particular case, when you look at the transaction cost, the company incurred a transaction cost of 30,000 rupee. Now this 30,000 is being incurred in terms of organizing the entire proceed, which is FL and equity. So the standard says you got to divide this 30,000 in the ratio of the proceeds. Divide this 30,000 in the ratio of FL as well as equity. So we're going to divide this 30,000 in this ratio. So let's divide 30,000 in the ratio of 502, 800. So I think this works out at 10056. And this comes to 19,944. So we're going to split the transaction cost in the ratio of the FL and the equity which we have done on the split. Now, watch this carefully. When you are raising the money, the entry is bank account gets a debit and FL gets a credit, and the money raised is 502,800. This is the entry when you raised the money. Now, when you incur a transaction cost, what I'm going to do, I'm not going to put the entry P&L debit. I'm going to basically put the entry FL debit. So in this case, the amount which is the transaction cost will be debited to the financial liability and it will be netted off. So 10056, the transaction cost in this case is going to be debited to the financial liability. So what we're going to do, we will convert this TC and take a net proceeds. Whatever transaction cost is incurred, it will be considered that this money is incurred to raise the money. So effectively, did the company raise 502,800? No. I would say the company has raised the amount which is a difference between the two. So this amount is going to be debited to the financial liability. Similarly, the money which is incurred in raising the equity part, this is also going to be netted in terms of equity. But what we're going to do in this particular case, this amount will enter in the tab number 1 of SOKI. So we'll put this as a component which is a tab 1 of SOKI. But as far as this element is concerned, this is going to be reduced in terms of tab 2. We will reduce this from the retained earnings in terms of tab 2 of SOKI. So let me put this once again to you as far as the treatment of TC is concerned. When the company incurs a transaction cost, we need to first split that transaction cost between the FL and the equity component in the ratio of proceeds. You do the split accounting ignoring the transaction cost if any, and then this amount of TC is simply divided in the ratio of proceeds. The money which is relating to the TC which is relating to FL is being netted in terms of FL. Because we are indirectly saying that you've raised a net amount of money by incurring this TC. But as far as the amount of TC relating to equity is concerned, this is going to be reduced and directly taken in retained earnings, not in the P&L. This is going to be directly reduced in terms of retained earnings, and the amount which is the equity component will rest in terms of tab 1. But now there is another problem. And the problem is, if you reduce this TC from the financial liability, now watch this carefully, it's a mathematical agenda and get this clear. In terms of financial liability, you said whatever is the future payments, let's discount them. But the future payments which you discounted was the dividend of 10%, mind you. When you took the financial liability, you said let's discount the dividend at the rate of 10%, and you discounted and got the money. Now you reduce the TC from this money. Will you be able to compound this at the rate of 15%? What do you say? Get this mathematically clear. You're saying the dividends which you're going to receive, let's discount them at 15%. You get a figure. And what is that figure? The figure is 502,800. Now, suddenly from this 502,800, you reduce the amount of TC. Will you be able to compound this net figure at 15%? The answer is
No.
in this particular case, if you discounted at 15, you got 502,800. You can compound 502,800 at 15. But if you reduce the TC, you cannot compound at 15, which means you need to revisit and calculate a new discounting rate. I remember the questions which came in the exams based on this particular question, the new interest rate, the new discount rate was already given in the question. You want me to directly consider the new rate, or you want me to tell you how we are going to derive this new discount rate as well? Your choice. If you want, I'll directly pick up the new rate, and if you want, I'll give you how do we calculate the new rate.
We want calculation.
Okay, then I'll give you the calculations as well. So in this particular case, let's have a look at how do we calculate the new discount rate for the purpose of computation. Now, what we need to understand in this particular case is one simple little inputs. I'm now going to take you to financial management, and I'm going to basically make a run through in terms of the concept of internal rate of return. So what is the calculation? Let's understand this. Let's consider the cash outflow on one hand, and let's consider the cash inflows on the other hand. When you calculate the internal rate of return, you should start thinking from the investor's point of view. I'm just reminding you, like for example, when you calculate a cost of capital in financial management, I'm reminding you the financial management concepts. So what do? We are calculating the internal rate of return from the investor's perception. So in this particular case, let's think from the investor's point of view, the holder's point of view. So we can say there is an outflow at time 0 and there is an inflow over the next 5 years. Let's say, for example, if I'm looking at the inflow, this investment will give you 1,50,000 dividend every year. So the inflow which we are getting, the inflows which we are getting is 1,50,000 every year for the next 5 years. And we decided that the present value of all these inflow, the present value of all these inflow is equal to 502,800. So this is 502,800. So indirectly we can say that 15% is nothing but internal rate of return. Let me put this again. So we're looking at the entire deal from the investor's perception. Internal rate of return is the rate at which the NPV is 0. So if you look at from the investor's point of view, he is getting an inflow of 1,50,000 each year for the next 5 years. And we're also looking at that 15% is the rate at which the present value of inflow equals 502,800. So which means NPV is 0 at the rate of 15%. Now, when you consider a transaction cost, you reduce that transaction cost. My transaction cost is 10056. We said we're going to reduce this transaction cost, and therefore the outflow undergoes a change. So in this particular case, 502,800 minus the TC, this comes to 492,744. Now the outflow changes, so you need to now consider what is the rate at which the present value of 1,50,000 equals the net outflow. I hope, friends, I'm making logical sense to you. So in this particular case, I need to find out what is the new internal rate of return. I'll put this back again to you. When we did our calculations on the split accounting, at that particular stage, we made one thing very clear, that this is the inflow from the investor's perception and this is the present value of all the inflow. So if you consider 15% from the point of view of NPV, I would say at 15% NPV is zero, because the present value of all the inflows and the outflow is equal. So indirectly 15% is IRR. Now, when you reduce the amount of, you can say, TC from this amount, the outflow goes down. But of course, the inflow remains the same. Now, if the outflow goes down, now you need to see what is the discounting rate at which the present value of all this 1,50,000 is going to equal the amount of 492. That is, you can say, the new discounting rate at which the compounding or the unwinding will be done in the ledger account. And I think I would like to make another sentence at this stage. If this clicks, you get more clarity. I guess you all know the basic fundas of financial management, that in this example, if your outflow is come down, what do you think? Internal rate of return is going to increase or decrease as compared to 15%?
Increase, sir.
Wonderful indeed. With the same inflows and the outflow going down, one thing is pretty clear: your internal rate of return will increase. And if this will increase, will it also increase the finance charge? If this
Yes,
goes
sir.
up, this will also increase finance charge. And if the finance charge goes up, are you indirectly spreading the TC in the form of increased finance charge? Yes. So when you're calculating this new, you can say, IRR, when you're going to calculate a figure which is going to be more than 15, indirectly your interest cost will go up. So by making a reduction in terms of FL, your amount of, you can say, IRR pushes up. And with that increased IRR, you are going to get a enhanced interest finance charge in the books of accounts. So indirectly your TC is going to get spread over the period of 5 years in the form of increased interest. Now what I'm going to say is going to sound very technical, but I want to say that if your FM concepts are good, if I were to calculate the interest at the rate of 15% without a TC, if I were to calculate, let's say, the interest at 15% without a TC, and if I were to calculate the interest based on the new IRR after reducing the TC, can I say the difference in the two interest will be equal to the TC? I don't know if I'm making sense to you or not. Am I? I'm just thinking that you calculate the interest charge at 15% on the figure 502,800. You calculate the interest on the new IRR on that net figure, which is 492,744. The interest at 15% on 502,200 and the new interest rate, which is on 492. Compare the two interest, the differences will be equal to the TC. I don't know if I made sense. Very technical. Did I? Let it be. You can do this exercise. I don't want to get into that exercise, but if you do this, you will be able to mathematically prove the point that the transaction cost is getting spread over the period of time. So now I need to calculate this internal rate of return. We know it's going to be more than 15%. Let's use a hit and trial. Let's calculate the NPV at the rate of 16% and watch out the results. So let me do one thing. Let me calculate at the rate of 16%, 15 and 16% both. Let's calculate the NPV and then we'll try to interpolate and calculate IRR. So let's consider the present value of cash inflow. Let's consider the present value of cash outflow. And we can calculate the net present value. So this time when you're calculating the inflows, it remains 150 for the next 5 years. But when you're going to consider the outflows, it would be net of TC, which is 492,744. 492,744. So let's see what is the cumulative factor at 15%. I think it was 3.352 if I rightly remember. I hope I rightly remember that. And 16%. I guess it is 3.274. Just vouch me if the present value factors are correct.
Yes, sir.
Perfect. So 1,50,000 into 3.352 minus the outflow. This is coming to 10056 positive. Oh my God. I'm definitely inclined in terms of asking a question. You can see at the rate of 15%, your NPV exactly equals the TC. Is this by chance or got to be?
Got to be.
100% got to be, because at the end of the day, the inflow is the same. The outflow stands reduced by TC. So if you recompute your NPV at 15%, it has to be equal to the TC itself. Let's see now at 16%.
It's minus 1644.
That's right, 1644 negative. So one thing is very clear, that if NPV at 15 is positive, NPV at 16 is negative, the IRR definitely falls in between the two. So we just need to do the interpolation. I'm just going to directly do the interpolation, what you do in financial management, and get my internal rate of return. So let's see the internal rate of return. The interpretation would be 15% plus. We're going to consider the NPV at 15% divided by the difference in the NPV. So when you take the difference in the NPV, this minus will become a plus. And the gap of the range is supposed to be 1%. So we can get the internal rate of return. Let's see what is the new internal rate of return in this case. So we've done the
15.86.
interpolation. Comes to, sorry?
15.86.
15.86 is the new internal rate of return. Okay, now once we get the new internal rate of return, so all this, what is the new additions I've given you, is pertaining to the concept of a transaction cost, which means even in the previous questions, what you've done, if there is a transaction cost, a similar kind of calculations need to be done in those cases as well. Now let's have a look at the ledger account. So we're going to again make the ledger account for a financial liability. And we are also going to consider the equity component of the instrument as well. So let's begin with the bank figure. And remember, now when you go to consider the bank figure, you need to consider the net amount. Since the amount of transaction cost stands reduced, the figure in the ledger account is going to be reduced at 492. So that was, I guess, 492,744. 492,744, and you start doing an unwinding as well. Are you going to unwind at 15% or are you going to unwind at 15.86%?
15.86.
Wonderful indeed. So we are going to unwind this at the rate of 15.86% because this is the net figure. So unwinding will also be done on the net figure itself. So 492,744.
78,149.
78,149. That's right. And then we make a payment at the end of first year. That was on 15 lakhs at the rate of 10%. That comes to 1,50,000. And I am going to make the ledger account for the next 5 years to give you clarity of thoughts. Let's get the balance CD as a balancing figure.
420,893.
420,893. So this becomes balance BD in the next year. Again, we take the unwinding at 15.86%.
66,754.
66,754. And the payment again is 1,50,000. By the way, can I say this ledger will turn out to be what? Will it turn out to be zero at the end of the 5th year? Because all the dividends
sir.
will be paid and it should turn out to be zero. So let's take the balancing figure.
33, 76, 47.
73.
33, 76, 47.
Okay, that's great. So 33, 76, 47. Again, we take the unwinding finance charge, 15.86%,
55, 551.
55,
53,
581.
551. Sorry, sir. 53, 551.
Oh, sorry, 53. Can you please come again? 53, 581.
551.
551. Then again, we make a payment of 1,50,000 at the end of the year. We get a balance CD, balancing figure,
241, 198.
241, 198. So this becomes the next year balance. Again, we take the finance charge, unwinding,
38,254.
254.
38,254. Then we make a payment bank, which is 150. Get the balance CD again, balancing figure,
129, 452.
129, 452. Okay, now this is the fifth year, which is the last year. So I'm not going to calculate the interest. We'll take it as a balancing figure. So we just make the payment.
25,58.
Yes, 1,50,000. How much is the interest?
540.
2548.
2548. Just see, is this coming approximately equal to 15.86%? Yes, I think it is coming to approximately 15.86, I guess. Right, so this is the financial liability ledger. Now I also want to look at the equity component, what happens to the equity component. So let's see what is the status of the equity component as well. So as far as the equity component is concerned, let's see the status in terms of SOKI. So I think if you've got a clearer understanding of the picture, then you can definitely tell me what is going to be the status as far as the tab 1 is concerned. Do you think this tab 1 will enter the tab 2, or do you think a portion will go to tab 2? What is your inputs on that? My equity component is standing at, I guess, to the extent of 997,200. So this is 997,200. Can I say, just like a partly convertible instrument, even a compulsory convertible instrument, you will issue shares at the end. So can I say you are going to transfer a portion in the tab number 2, which will be security premium? And can I say a portion of this will be transferred in terms of equity share capital? Am I right? Just like a partly convertible instrument, a portion becomes a premium and the portion is going to be equity share. So you can say the entry is, the equity component is 997,200. And I think in this particular case, if you ask me, I'm also given the number of shares as well. So the company is going to issue equity shares. He's already said a total of 5,000 equity shares will be given at the end. And what was the face value? So I guess if I go back and see, we given that the face value of the equity share is supposed to be 10 rupees each. So we're also given that in this particular case, the number of equity shares is 5,000 into 10. So can I say whatever is the balancing figure, that is going to become a share premium which owes in tab number 2. So I think all the insights from the split accounting to the initial entry to the permutation combinations of how the FL and the equity components are dealt with, I have given you a flavor of all the permutation combinations in this case. I think now it makes sense that we make a comprehensive chart on this, which gives you a bird's eye view of everything before we take the journey forward. So I'm done with perpetual debt instruments. I'm done with the instruments which are compulsory convertible, partially convertible, and optionally convertible in nature. Let's make a summary now. So as I said, requested earlier as well, you need to please do all these questions by hand. Once you're going to do them by hand, you will definitely get a good hang in terms of the split accounting of a CFI. Okay, let's, I think, begin the journey. I am now making a small little mind map. So we're just going to create some columns, and I have 4 cases with me. I'm looking at a perpetual debt instruments, optionally convertible instrument, partially convertible instruments, and compulsory convertible as well. So let's take a column for particulars and a few questions I'll ask you if you are able to fulfill this chart. If you're able to draw this chart and give me inputs, your fundas are going great. So this is a little mind map which I am creating on the concept of compound financial instruments. So the first one is what we are looking at is a perpetual debt instrument. Second one, we are looking at optionally convertible debenture, I'll put it. Then partially convertible debenture, then compulsory convertible debenture. You can take preferentials as well, but one and the same thing effectively. Okay, let's, I think, begin the journey in this particular case. So I am going to first consider when you do the split accounting, what is taken in the financial liability element? Are we going to consider interest in principal or just interest? Whatever. Let's begin. Can I say in terms of the perpetual debt instruments, the FL includes only the interest element, correct?
Yes, sir.
In terms of optionally convertible debentures, we are going to consider both of them, correct? We took the interest
Yes.
element as well, and we took the principal because there is unavoidable obligations to pay. Okay, in terms of partially convertible debentures, we definitely took the interest into account, interest or dividends, whatever you can call it. Since I made a mention of debenture, I'm calling it as interest. And are you going to consider the entire principal or which principal? The convertible
Non-convertible portion.
portion or the non-convertible portion?
Non-convertible portion.
Yes, we will take the principal, only the non-convertible portion. I'll put it as non-convertible in the brackets. And for compulsory convertible, we are considering only the interest element, again, not the principal element. Your focus point 1 needs to be very clear which element is taken as a part of the FL measurement. Next. I'm now focusing on the second input, and that is in terms of the discounting rates to be used. In order to calculate the FL, we need to consider the discount rate as well. So can I say in terms of the perpetual debt, market rate? And in terms of all other instruments, can I say the rate on a non-convertible instrument, right? Here I would consider a market rate, which the question will give me. And in all these cases, if you remember, I will take the rate on non-convertible instrument. The question will give you what is the rate of interest on a non-convertible instrument, and that would be taken for the purpose of calculating the present value. Next, number 3. My third agenda is what is the treatment of the equity components at the end. So let's ask you, in terms of a perpetual debt, does it go to tab 2 entirely on liquidation? In terms of a perpetual debt, can I say it gets transferred to the tab 2? 100% on liquidation of the company, correct? And we're going to put this in retained earnings of tab 2. In terms of optionally convertible debenture, can I say this money is going to be put in capital reserve or share premium as the case may be? So this is going to be transferred again to the tab number 2, and this will again be 100%, and this will be either transferred to capital reserve or it will be transferred to share premium, depending the shares are given or the cash is given. If the cash is given, it's capital reserve. If the shares are given, it is share premium. But of course, you will appreciate that the full amount is going to be transferred in terms of the tab 2. Let's consider the partially convertible debenture. Can I say in this case, we are again going to transfer to tab 2 full amount or a portion?
Portion.
And that's right, we're going to transfer only a portion, and this will be to the share premium. The rest will be transferred as equity share capital. And same goes out here as well. This will be transferred to tab number 2, and here again a portion is going to be transferred as a part of the share premium. Anything else which you want to add in terms of this mind map? I guess I'm not putting TC, but I think I'll just put it in journal. As far as the TC is concerned, I'll just put the input as a separate note that if you are given a TC, if TC is given, we need to compute new discount rate. And how do you calculate a new discount rate? That we've already seen in the question. Wow, wonderful indeed. I think my entire concept on a compound financial instruments with a complete level of details is taken care of. Super. Okay, now let's come back to the journey. We are now back on the agenda. I have done a couple of questions on unit number 3. Certain questions are on similar lines, which I think you can definitely do in the unit number 3. Okay, now I need to take you to another last agenda in terms of compound financial instruments with you. So there is now a last agenda in terms of a CFI. You can call it as a special issue relating to compound financial instruments, and that is called early redemption. A company issued a compound financial instruments for a period of 5 years, but let's say in between, the company has got the right and it wants to go for an early redemption. So we are now looking at a special case when there is an early redemption of a compound financial instruments. How does the accounting take place? Which I will illustrate with an example directly itself. Let's have a look now on question number 5. So let's have a look at a question number 5 where I'll explain this particular concept. It says on 1st April X4, the company issued 5,000 8% convertible debenture with a face value 100 each, maturing on March X9. That means a period of 5 years. The debentures are convertible into equity shares at a conversion price which is 105 per share. That means the debentures are convertible at a premium. Interest is payable annually in cash, so the interest is paid in cash. And at the date of issue, S could have issued a non-convertible debenture with a 5 years at a coupon rate of 12%. On 1st April X7, in between, that is after a period of 3 years, the convertible debentures have got a fair value of 525. S makes a tender to debenture holders to repurchase the debentures for 525, and the holders accepted the option. At the date of repurchase, S could have issued a non-convertible debt with a 2-year, because now only 2 years are pending. Out of 5 years, 3 years have already passed by, so another 2 years are pending. and which is at the rate of 9%. Show the accounting entries in the books of S for recording the equity and the liability component. So as we can see, the special agenda in this particular case is the early redemption of this convertible instrument. After a period of 3 years, the company makes an offer to the debenture holders that I am going to redeem the money. So what happens in this case? Let's have a look. Further, I am also given the accounting, what he says. So what he's asking me in this particular case, I am given what he's asking me is the entries at 2 stages, at the time of initial recognition and at the time of repurchase of the convertible debenture. Okay, so first of all, what you need to do, you need to start off, kick off the question absolutely in a normal manner. Just do the normal split accounting, what you do at initial recognition, make your ledgers for a period of 3 years, then we'll see. So let's, I think, take it out here. This is question number 5. So I'm looking at the question number 5. This is a special issue. We are dealing with a special issue on a compound financial instruments. This is called early redemption. This is early redemption of a compound financial instruments. That is the special agenda. So at the first instance, we will start off the question in a normal manner. We'll do the accounting as it is usually done. Let's do the split accounting. So let's see what is the proceeds. And we will segregate the proceeds in terms of FL and equity. So we need to go back and see what is the proceeds. So we've issued a total of 5,000 debentures with a face value 100. So the proceed is supposed to be 5 lakhs. And we segregate this in FL as well as equity. So in terms of FL, now this is supposed to be what? Optionally convertible instrument. If it is optionally convertible instrument, are you going to consider in the FL the interest, or you're going to consider interest and the entire principal as well? What do you say? Optionally convertible.
Both interest and the entire principal.
So we're going to consider both of them. So let's see what is the coupon rate. The coupon rate is 8% and the redemption is going to be at 105. That means at a 5% premium. So this is for a period of 5 years. So let's consider on 5 lakhs. 8% is the coupon rate and we need the PVIFA, which is at the rate of 12% for a period of 5 years. Then there is going to be a redemption also at a 5% premium. We need a PVIF at the rate of 12%, which is the 5th year end. The discounting rates are already given in the question as well. So maybe we can pick that up. So let's see what is the discounting rate at 12%. 5th year end is 0.567. Let's take the cumulative. I think 3.605. This is 3.605 and this is 567. So we can get the financial liability element as well.
4,27,700.
Okay, that's great. I'm just going to keep the question also open in front of me. Sorry, can you come again with the figure, please?
4,27,700.
4,27,400. 400, right?
700, sir.
700, sorry. So 427,700. 4,27,700 is the financial liability. So we can take the balancing figure that is supposed to be the amount which is the
72,300.
72,300 is the balancing figure which becomes an equity component. So we've done nothing special. We've done exactly what we've been doing so far in the question. So in terms of the split accounting, we just took the difference. Now I think let's go further. So we're going to make a leisure account for a financial liability, and for the equity component, nothing changes. So we'll make this for a period of 3 years because the early redemption take place after a period of 3 years. So make your ledger accounts at the end of 3 years to begin with. So we've got a financial liability. We take the bank figure, and as far as the bank figure in this case is concerned, what was the bank figure? This is 427,700. So what is the rate at which the unwinding will take place at this stage? 12%. So let's see, 12%, what is the unwinding?
51,324.
51,322. And then we make a
324.
payment, 324. Yes, 51,324. And then we make a payment which is at the rate of 8%, coupon rate, which is 40,000. So the payment is made at proceeds of 5 lakh at the rate of 8%. Let's see the balance CD as a balancing figure in this ledger.
4,39,024.
4,39,024.
024.
Okay. So this becomes a balance BD in the next year. Again, an unwinding is done at the rate of 12% on this.
52,683.
52,683. And then again, we make a payment of 40,000 at the end of second year. We get a balance CD, balancing figure.
4,51,707.
4,51,707. So this becomes a balance BD in the next year, 451,707. And then we again need to consider the unwinding at 12%.
54,205.
52,405.
54,205. Sorry.
Yeah, 52,405. Right. Okay. And in this
54,205.
sorry, I missed it again.
54,205.
54,205. Okay. Now, in this particular case, let's keep the ledger here only before we make any payments, because now we gave them an offer to pay. So in this particular case, first let's pay that bank balance of 40,000, but leave the ledger out here itself. Because at the end of third year, the company gave the offer to the holders that I will do an early redemption. Now, we are going to also consider new calculations. So we can say on the early redemption, what do you need to do? Let's go back to the question. So coming back to the facts of the case, it says now the debentures at, it says on 1st April X7, the convertible debentures have got a fair value of 525, and X makes a tender offer to the debenture holders to repurchase them at 525. So on 1st April X7, so I think we can close the ledger, but they offered them 525. So let me first close the ledger, get the balance. Let's see the balance on 1st April.
465,912.
Sorry, can you come again, please?
465,912.
Okay, 465,912. Okay, now this is the balance in the financial liability. And if somebody were to ask me that what is the balance in the equity component, can I say that would remain the same, which was identified at the very inception? Because the balance in the equity would remain constant till the end of the redemption. So I'm not worried on that. Now let's come to the case of early redemption. The company told the holders that we're going to give you 5,25,000 as a consolidated amount towards early redemption. But now the question rises that out of this 525, what is paid towards the FL and what is paid towards the equity? So the standard suggests us that if the company goes for early redemption, you need to split that 525 into two components. So what are you going to do in this particular case? Again, do a split accounting the way it is done at the initial recognition. But this time when you do the split accounting, the discounting rate to be used is the rate which is prevailing on the date of early redemption. I put it again. Now what the company needs to do when they are offering an early redemption, they need to split that offer price, which is 5,25,000 into two components. They need to do the split accounting exactly the way it was done on initial recognition. But this split accounting is based on a discounting rate prevailing on the date of early redemption. Now, if you go back to the question, you can see the data given in the question at the end. It says on the date of repurchase, S could have issued these debt with a 2-year remaining at a 9%. So the split accounting will be done based at a 9%. So we'll again do a split accounting of this 5,25,000, which is the offer price. And whatever is the remaining obligations, we'll do the discounting of the remaining obligations to get the financial liability, and we'll get the equity as a balancing figure. So let's see what is the obligations pending. How much more interest are pending now? Out of 5 years, 3 years interest is paid. So we've got a payment of another 2 years coupon rate. So what was the coupon rate on 5 lakhs? I think 8%. We need a discounting at 9% for a period of 2 years now. And there is a principal money which is at 5% premium, right? So this is at a 5% premium into, we need a 9% second year end factor. So this is now the new discounting rate at which we are standing on the date of conversion. So let's see the factors at 9%. I guess this is 0.842 if I'm right. And this is 1.759. Just check
Yes, sir.
the factors.
Yes. Sir.
Right? Okay. So let's see what is the financial liability element now. So 42,050. Is it coming to 512,410? Just see if this is correct.
491,360.
Oh, I'll just check it again. This is 70360. I think it is 512410. Just see.
Yes, sir.
Correct. Then we can take the equity as a balancing figure in this case. So out of 525, this comes to 12,590. So we basically done the split accounting of that 5,25,000, that out of this 525, what is the money offered against the FL and what is offered against equity. Now what do we need to do? Compare. So let's do one thing. Now let's make a comparison. So I am now going to first organize the data and then put an entry. So I have the financial liability component and the equity component. We've got the book value of the FL as well as the equity component. Now look at the ledger account, and based on the ledger account, see what is the book value of the FL. 465,912. This is 465,912. And what is the book value of the equity components at the inception? 72,300. This is the book value of the equity component, which means You made a ledger account for a period of 3 years. So you already have the information of the FL book value, and the equity component remains the same, which was identified at the inception. Now see what is the fair value split we have done. We've just taken the fair value split of the offer price 512410, 512410, and we can see it is 12,590. So which means against the offer price, against the book value, there is a certain offer price which is being given to the debenture holders. Now, let me ask you something. If against the book value, you are getting this amount which is more, is there a gain or is there a loss? The book value is less, the offer price against that component is greater. Can I say this becomes a gain for sure? So let's take the difference, 465,912 versus 512,410. This comes to 46,498. And this gain is going to be taken in the profit and loss account. Let's also have a look at the entry, which will be done for the settlement of the FL component as well. So let's see the entry. So in this particular case, the journal entry which we are going to pass in terms of this component, the financial liability which is in the books of accounts at a book value gets a debit, that is 465,912, against which, I'm afraid the company is making a more amount. My mistake. This is not a gain, it's a loss. The company is giving a more payment towards this particular amount. It is paying more than the book value. Oh, I think that's the reason everybody was silent. So the company is making a payment more than the book value. So against the book value, the payment made by the company is 512,410. So this is going to be the balancing figure, which is a loss, and this loss is going to be debited in the profit and loss. By doing an early settlement, in this case, the company suffered a loss, and which is going to be taken in the profit and loss. Let's see, this is 46,498. Now let's look at the equity component as well. In terms of the equity component, the company is paying a lesser money. The book value of the equity component is greater, and the money offered against that is less. So this is going to be a gain, but this gain is not to be taken in the P&L, because for Ind AS, every time there is a related to equity shareholders, the gain or loss is always taken to equity. So the settlement of the FL component will be a gain loss in the P&L, but the settlement in terms of the equity component is going to be taken directly in SOKI, that is in the retained earnings. So this is 72,300 minus 12,590. This is 59710. Let's also have a look at the journal entry for understanding point of view in this case as well. So if I look at the journal entry in this particular case, your equity gets a debit. And this is which equity? It is the tab 1. Though it is basically going to be a change in terms of one component of equity to another component of equity. So this equity which is there in tab 1 gets a debit. And the money is paid, which is 12,590. And there is a gain, which is a balancing figure. This is also going to be taken in equity, and this will be in terms of tab number 2, which is retained earnings. And that is 59710. That is the balancing figure. Wow, this I think takes care of the concept of how the redemptions will take place, the entries and all. So basically what we did, when there is an early redemption, the offer price is to be split in terms of FL equity. The only care which you need to take care is that the FL equity at that stage will be based on the discounting rate prevailing on that date. Then it is a simply comparison of the book value versus the split of the offer price. You compare the book value of the FL equity with the offer price. Any gain or loss on the FL component goes in P&L. Any gain or loss in terms of the equity component gets settled in terms of equity. So this is the special issue with reference to the calculations of early redemption of CFI. Our unit number 3 as well as a unit number 1 of the study mat is complete. My perception in terms of the issuer is completely done. Now you should be very clear in terms of FL, equity, CFI, hybrid instruments. The accounting for FL is still pending because that's going to be covered in terms of 109. But if you ask me effectively, Index 32 gets over at this stage. Our journey now is going to start in terms of Index 109 in the next class. And as I said early today, that there might be a little apprehensive with regard to the kind of accounting done in the financial liability ledger, which you are going to get a good detail because I will explain you the different measurement bases available under the standard and why those measurement bases have been developed and what is the logics and all those things that will be discussed at a good length in the next class. The next class is going to be very crucial indeed because I am going to do a lot of grounding work in terms of Index 109. But effectively now you can practice your inputs in terms of Index 32. Okay, friends, so I think that's quite a heavy day indeed. Let's see if you've got any questions on your mind. If there are any questions, please go ahead. If there are no questions, then I think we are going to call it as a day. But it was not a very, very technical day. Since we did a lot of computations and all, you just need to go and sit back and revise all these details, practice them by hand, you will get your expertise done. Clear indeed, that's wonderful indeed, friends. So I think on that note, time to say goodbye to you. So I'm going to see you on Thursday. Till then, bye-bye and take care. Samant opening, teaching, no question left. Mouth opening, teaching, no question left. That's great indeed. Thank you very much indeed. Bye-bye and take care on that.